Hey, everybody. Welcome to week 67 of the Ag Commodity Corner Plus podcast. And today is the 17th of July, 2026. It was a big week in terms of geopolitics, Mo. What are we talking about?
Wheat futures skyrocket. Is this a repeat of 2022? Let's get into it. Here's your summary weekly quote chart. And I highlighted corn and beans because it was a higher weekly close, so that was considered a win. In fact, soybeans is the second highest close of 2026. We're basically testing the 2026 May 13th highs. Oil came back with a vengeance, although still below the high at 78 cents. And then we've got all the wheat, obviously markets surging. Both Chicago and Kansas, second highest close so far. The weekly higher close gives you that bullish continuation momentum into next week. Minneapolis is lagging, but still closed higher. You'd have to get up to like 750 from the May 13th high. We got hogs recovering, bouncing. I'm not sure what the cutout did today, but it was the 4 consecutive higher closes on the cutout. Live cattle, feeder cattle, correcting lower cash, but still maintaining that long-term channel bullish trend. We'll show you that later. Crude obviously higher because of increased tensions there in the Strait of Hormuz. And we mentioned a target last week. We'll review that this week. Gold is almost breaking 4,000. Natural gas intraday traded to a new contract low, so a lower input again as we get into the end of 26 for farmers. And then silver is breaking below, actually trading to new lows for the year. So let's get into it. Let's start off with this, I guess, this escalation in Russia and Ukraine.
Yep. So Ukraine's unmanned systems forces, primarily drones, have successfully targeted over 147 Russian vessels in the Sea of Azov in a highly effective drone and missile campaign. The strikes have effectively shut down the crucial waterway, forcing Russia to suspend shipping through the Kerch Strait and halting grain and petroleum exports that fund, which is key, its war effort. Prior to these strikes, the Sea of Azov served as a vital, relatively safe rear staging area for Moscow. Now the attacks have prompted the Kremlin to seek alternative land-based routes for supplying forces in Crimea and rerouting grain shipments.
Okay, so if we look at this map, here's your Sea of Azov. And so, you know, Ukraine has been winning the war lately after 4 years. They've struck about 147 vessels. They've, according to reports, I'm not sure there's, I can't confirm it, but they've sent drones 1,500 miles deep into Russia to attack refining facilities. They're having issues with fuel production, diesel fuel, jet fuel. So they want to now reroute some of their exports through, and here's that Kerch Strait, but they want to reroute exports down into Odessa, into this particular port here. But Putin is upset. He struck another port near Odessa. It controls about 90% of Black Sea grain exports, particularly Ukraine. So not only are you Russian exports are at risk, but also Ukraine now. And so I think the markets have added a geopolitical risk premium. This is almost like a black swan where you would say to me that, hey, the largest exporter in the world of wheat, Russia, is going to be down 30 million metric tons because of a drought. We're not cutting production. We're not lowering global ending stocks by any means, but we are slowing down that export to the world. And both Ukraine and Russia represent about 30% of total global exports. And so this is a big deal. This could be a short-term game changer. You can see this is Kansas City weekly futures chart, obviously a bull. and we've risen back above the 200-day. The reason why we had a target of 820 during that May 13th high is because when you take a Fibonacci retracement back to the 22 highs, you get back to 820. So I think the longer this plays out, and I didn't think the funds wanted to remain short going into the weekend. If this thing gets extended into August, you're going to displace about 5+ million metric tons of grain. And I think the market will have to continue to add a risk premium to futures. So this is HRW wheat. This is your CFTC chart with respect to Kansas City wheat futures. You can see the funds had added some length going into that May 13th, subtracted some, still long, but you can see the high here through 2018 at 70,000. So maybe they're long about 20,000 real time. I would think they're a little bit longer than that. This is your latest CFTC update as of today.
This is as of the 7th of July, and the new attacks supposedly began on the 6th of July. So hasn't really accounted for a lot of that recent short coverage.
Yeah, so maybe we're 40,000 in real time long. They've added to their long positions after this week. So there's still some ability to go even longer into next week. So I don't think the highs are in just yet. This is HRS. HRS is in trouble because we're hearing from farmers in the Northern Plains where that heat is in Minnesota that the wheat is just slowly dying a slow death because it's turning white because of the heat. I think the USDA was, we've talked about this, premature in increasing the HRS wheat yield in the July crop report. But I think that, they had an opportunity to do it because we had so much moisture in June, but I think it's going backwards since. So look for the funds to probably start. You got a lower yield, lower production, plus this issue in Ukraine, Russia, and you could see the funds add to their length in HRS. It's lagging. The high on May 13th was closer to a 750, now a high 690s. And then SRW, very barely long. Maybe they're long. Maybe they're I think they're short slightly, but maybe they're flat as of this week. And so you can see if they really want to go long, they have a lot more room to do that. And so, again, I don't think soft red is quite peaked yet. And then this is the combined SRW, HRW, HRS total for managed money funds. And it looks like they're almost, after this week's performance, I would think they're just slightly flatter or slightly long. You can see they can go long 133,000 combined. So the HRW U.S. crop is coming to an end. Do we get a post-harvest rally in August? August could be interesting in the wheat market. Don't forget to try our program. This week we were talking to our clients about the 2026 summer heat wave and the impact on crop yields. We are calling it, we are saying that basically the funds are sleepwalking this. Look, if you're concerned about the spring wheat crop in the Northern Plains because of the dryness and the heat, why aren't you concerned about the corn crop? Why aren't you concerned about the soybean crop? I think the funds still assume they're not spooked by the potential for lower soybean yield in the United States. It starts with the August 12th crop report. If you want lower yields in the U.S., the USDA is going to have to tell you that story. We could argue all day long about whether it's 183 or lower. But if they start to lower the yield or increase the yield in August, then they start to trend. So if it's a lower yield in August, then it's lower in September and so on and so forth.
A severe mid-July heat wave is impacting U.S. ag with triple-digit temperatures and dry patterns stressing crops in the U.S. northern and central plains and also the western corn belt. The heat is starting to impact yields in the Dakotas and Minnesota as farmers are saying corn yields are falling and spring wheat is turning white. The northern plains recently shattered all temperature records. The U.S. weather forecast remains hot at the end of July after a brief cooler week next week, but it turns drier into the last week of July. The high-pressure ridge expected to return to the eastern corn belt for the first half of August.
Yeah, so this is the one on the left is the European model, and the one on the right is the GFS America model. You can see earlier forecasts for these two maps for the end of July. They were the European model was throwing a little bit more moisture, ridge riding storms over this high pressure ridge. It's a little bit less. It's drier, is what I'm trying to say. It's not as wet as it was, whereas the American model has always been drier. So, and then you can see from this chart that there's those ridge riding storms. It's a little bit less than what they were forecasting. A little bit drier here into the Midwest. Still wet in the very southeast. The chance of a half-inch precipitation during this period is very small. So you're going to continue to get some heat. Maybe you're not going to get the 100, 110, but if you're still getting 90 degrees with very little moisture, I think it's going to continue to stress these crops. And then this is your outlook through the end of August. Again, it looks so that this high pressure ridge is moving more eastward back into the Midwest. That could impact that reproductive stage in soybeans.
Let's stick with geopolitics. And just 3 commodity vessels crossed the Strait of Hormuz yesterday, which is the fewest daily transit since May, with most ships halting or making U-turns after recent Iranian attacks on vessels and the resumption of a U.S. blockade on Iran-related shipping.
So I think short term, it puts some upward pressure on diesel fuel prices, crude oil, obviously, and urea and fertilizer prices. But again, we've talked about this in the past. I think it's noise. It's tit for tat. Neither party can afford this. I still think long term we head back lower. But we talked about the 78.07 ceiling. We're breaking above that weekly, so the next target's 87. But again, I'm not sure that we're going to stay up here for much longer.
Let's talk about cattle, and cattle has been correcting over the last few weeks. Summer live cattle futures are off by about almost 10% since latter June, still at a significant discount to cash. Fundamentals, though, haven't altered much, and this could encourage the correction in futures could encourage some short covering at cheaper levels. Near term, some feedlots have opted to market cattle rather than risk further losses by holding on to them.
So you can see here, many are making a big fuss, sorry, about my circle, about this correction. But you can see this correction is no different than some of the ones in the past. And along the way, you just keep climbing higher. So again, this is our long-term bullish channel trend. And sometimes the funds will overshoot the mark to the upside, and then they overshoot to the mark to the downside. But over time, this lower end of this range tends to hold. We bounce higher and life goes on. And we actually, over time, trade to new record highs. So fundamentals have not changed. This is just more noise, whether it's live cattle or feeder cattle. Actually, the feeder cattle chart doesn't look as bad as the live cattle chart.
Let's look at the latest as far as the 2026 China-US soybean commitment tracker is concerned. So as of the flash sales from the USDA seem to be picking up steam of late. As of the latest, we are at 4.5 million metric tons of that 25 million metric ton target or pledge, which accounts for about 18% so far.
Yeah, so you can see down here that 1.892 is for unknown. We've talked about that. Unknown is spelled China. But if you subtract unknown, you're into that 2.4, 2.5 million. So it's what we're looking for. It's about 1 million metric tons per week in order to achieve the 25. Once again, I think we're on target, and over time, between the 45Z biodiesel demand and the Chinese demand. Remember, the USDA only has 16 million metric tons forecast in their export forecast for 26-27. So if they do achieve the 25, ending stocks are going to drop. Ending stocks get tighter, prices move higher.
Let's look at what's happening in the stock market. There again, recent correction seems to be this would be another low week. The NASDAQ has been correcting, having dropped roughly about 11% from its record high close recently. And this is due to a combination of the geopolitics that we spoke about, especially in the Middle East, which is causing fluctuations in oil prices, and concerns regarding corporate AI spending more. Semiconductors were hit especially hard as many stocks were priced to perfection.
Yeah, so I keep things in perspective. So some of these big names like Micron and so on and so forth, they've been taken down about 30, 35, some cases 40%, but some of these names were up 7, 800, thousands of percent in the first half of 2026. Remember, corporate earnings for the first quarter were up 26%. So, and tech took most of the credit. I don't think that's going to change in the second quarter. We're just about to get into second quarter earnings. If they come in above 20% again, I think what stocks are doing is they were priced to perfection, and earnings and revenue have to catch up to those stocks. They just got ahead of themselves. So corrections are healthy. I'm not concerned about it. I still think long term we head higher. In fact, the CEO of NVIDIA said that we're still at the beginning cycle of AI.
And finally, let's look at the latest CFTC, like you mentioned. This update is as of the 14th of July. And so I correct myself. I earlier said it was 7th of July, but it's the 14th. And as of the latest, more net buying in the grains, especially in corn, up by about 30,000, over 30,000 contracts, taking net length to 43,391. Soybeans up over 4,000 contracts, taking net length to 72,688. More buying in the wheats as well, like we discussed.
So in real time, I think the funds are probably a little bit more longer corn, probably 60,000. We're having a tough time breaking that resistance that's ceiling at 470. I think the longer the escalation continues with Russia and Ukraine, the higher wheat goes, the easier corn will be able to break that 470. Beans, I got to think we're closer to 100,000 long. Obviously, we're a little bit longer in the wheat, maybe not as short in the SRW. We've added to the canola length. Cotton was lower this week, so maybe they subtracted some there. Hogs, I don't think they're 30,000 short anymore after the rally here this week. Maybe back to flat, and of course they've subtracted some in the live cattle and feeder cattle. And so you can see from this chart where we hit a bottom at the end of June. We've been doing this for 25 years. I've never called a bottom in June. We did. Typically that bottom the last 5 years has been early to mid-August, or in the last 15, 20 years, October 1st. So again, don't overcomplicate this. This has to do with Chinese demand. If we didn't have that Chinese demand, that trade deal, without this escalation, Ukraine, Russia, it could be a continuation of the bear market. But the 3-year bear market is over. The supply side bear is over. We're turning into a demand bull market, and that's going to continue over the next 6, 12, 18, 24 months. Thanks for watching. Don't forget to subscribe to the channel. Avoid that Canadian smoke from Ontario, but enjoy the weather, the summer. Looks like tassel season in corn, and we'll see you next time. Take care.
Bye, guys.
Bye for now.